Chicago Bears new rookie, new number one draft pick, Caleb Williams, ran into some tax problems recently because he wanted to move his income over to his LLC just to save some money. But he ran into some issues with that with the NFL. So we're going to talk about today in this brand new show, in the first podcast episode of the Tax Problem Fixer podcast. And I'm a little rusty because I haven't broadcast in a while, but we're here and we're back at it. So, like I said, today we're going to talk about the whole Caleb Williams situation. And there's always a learning lesson in this because I see a lot of new business owners start with starting a business, starting their LLC, and they want to try to have either themselves or other employees get paid in an LLC. And a lot of times it just doesn't work that way. So, again, my name is Kamari Ellis. I am a 35-year-old, but I'm a 35-year vet in the tax industry. I've been doing taxes for I don't know how long, but I'm also an enrolled agent. So I'm an enrolled agent, tax accountant, and I've been here for a long time. And I do this show just to help people understand the tax system and financial system and break it down and make it a lot more or less complicated so you can make sense out of it. But like I said, as we get into today's show, this is the very first episode of the Tax Problem Fixer Show. And the name of the show is the Tax Problem Fixer Show is because I help people fix their tax problems every day. So I help people with tax issues with the IRS, with states, filing their taxes, creating tax strategies, and all the like. And so today, I thought it would be a good idea to talk about this Caleb Williams situation. And I just wanted to go over it real quick. And let me pull up a few things here so we can look at what they've been talking about. Now, Caleb Williams, he's a phenomenon, right? Number one draft pick coming out of USC, just landed a 4-year, $39.5 million contract, guaranteed. Got to give it up for that. Got to give it up for that. That is rare. That is really rare because most NFL contracts are not guaranteed. And what does that mean? It means that guaranteed is if they get hurt, they still get paid. Usually, a lot of times, if they get hurt, they don't get paid, or majorly hurt, they don't get paid. So this time, 4 years, he's getting $39.5 million over those 4 years. And so that's pretty amazing. That's pretty amazing. But the blogs have been talking about this. Everyone has been talking about this. And so I figured I wanted to give my perspective on this because I know there's a lot of people who've had questions about this and they've been inboxing me about it. And so I figured I would chime in on this. So let me pull this up real quick. Like I said, Caleb had $39.5 million contract. Again, that's pretty amazing. That's pretty amazing. That's not rare. He's rookie just coming into the league. And there he is at the draft with his hat on, just getting it. Now, to go into the details of this, $39.5 million contract, fully guaranteed. He just signed this contract on Wednesday. Now, his signing bonus is $29.5 million. And so that's not being spread out over 4 years. He's getting that this year. He's getting that now. So that's actually a really, really great thing. But when you average it all out, so you get the 25.5 million, and then you get roughly 3.5 billion each year for the life of the contract over those 4 years. So he's going to be doing pretty good. Now, right now, I'm broadcasting on Instagram as well. I'm going to end that live stream. If anybody wants to come over to YouTube, you can find me at the Tax Problem Fixer channel, and you can watch the whole show over there. Alrighty, I'll see you all soon. Now, when we go into this, and when we look at this, like I said, 39.5 billion. over 4 years is an amazing thing. Is an amazing thing. Now, there's been some news and some articles that people have been sending me about this whole situation because Mr. Williams wanted to have his monies, his paycheck, his income sent from the Chicago Bears because that's who he works for. He works for the Chicago Bears. He's an employee of the Chicago Bears. Now, that's going to come into play later on, so keep that in mind. He wants to then have his LLC get the money. And then there was also some other talk about him getting a forgivable loan. Now, that's kind of rough. That's kind of rough. Because when you understand the rules of income or understand the rules of tax, income is to be reported. And there are some rules about what organizations or your employer must do. And I see a lot of new business owners kind of run down this path, walk down this path, kind of stumble down this path, and they make some mistakes. A lot of times they want to pay employees, people that are working for them, as independent contractors, but they don't realize there's actually a distinction. And I know many people are going to say, well, what's the difference? 1099, W-2, it's all the same. To you, the business owner, it might be the same. However, to the IRS, to the Department of Labor, they look at things very, very differently. And it's important to understand how they look at these things differently, right? But when you look at this report here, it says Caleb Williams, LLC, got absolutely screwed by the NFL by forcing the Bears to give him a W-2 like the rest of us. Now, that's hyperbole. That's they capping it up. They boosting it up. The NFL didn't screw him over. It's actually the law. But I'm going to get into this real quick, and I'm not going to be here with you too long. But as they bring this up here, right, they say, in negotiating his rookie deal, Bears QB Caleb Williams explored creative tax strategies. Nothing wrong with creative tax strategies. From being paid as an LLC to having payments treated as a forgivable loan. Right? So I don't know if they're trying to say it was a forgivable loan that he would get from his LLC to him or from the Bears organization. But either way, that's illegal. And the reason why it's illegal is because it's income. And so somebody's got to pay tax on that. Now, I know many of you might say, I don't want to pay taxes. Well, I can't help you with that. All I can do is help you with what the law is and help you not get jacked up with the law so you can stay compliant and not wind up being hurt in this whole situation. All right. So here's the thing. So Caleb is an employee. By the law, he's an employee. He is not an independent contractor. He's not something separate or different. He's an employee. He's a 9-to-5 employee. He gets a W-2 at the end of the year. And there's some tests that the IRS does to determine if somebody is an independent contractor or someone that can be paid as an LLC or as someone who is an employee and gets a 9-to-5, works a 9-to-5 and gets a W-2. There's old tests. Like, if you've been rocking with me for a while, I have a saying. The IRS isn't that dumb and you're not that smart. They figured out a lot of these things before in the past. So keep that in mind. Keep that in mind. Now I want to pull this up. I'm trying to find it here. Give me 1 second. All right, I got it right here. And I talk about this a lot, but I want to pull this thing up because, again, a lot of people get confused by this. All right, so this is a website, irs.gov. Now, when they have it up and you see the highlights there, I've highlighted it several times, so those are old notes. But when it's a frequently asked question or something that gets a whole page, they talk about this a lot. All right, so you see here, independent contractor versus employee. So again, a lot of people get confused by this. So the Chicago Bears will be paying Caleb Williams as an independent contractor if his LLC will be getting paid. Now, I'm assuming that he would be a solo member LLC. Now, there's some other options he might possibly do, but usually, most times, with just one person doing all the work, they choose to set up what's called a solo member LLC. And a lot of people don't realize this. The IRS really doesn't care about solo member LLCs. The IRS doesn't really care about LLCs at all. You know why? Because LLCs are really a state designation. LLCs are not for tax protection, so to speak, even though everybody on social media world thinks they are or lie and say that they are. Okay. LLCs are more about liability or legal protections. They are not really there for tax benefits. So much so that even when you are a solo member LLC, you then still, when you file your taxes at the end of the year, you file them on your personal taxes. There's not a separate form for it. It's not treated like a corporation or a partnership. If you are a solo member LLC, your return is filed on a personal return. But now, as we go down here, you see I have a couple of things highlighted: independent contractor versus employee. And so here, I won't read all the things here, but there's another thing called here misclassified worker. That happens a lot. And the IRS is starting to crack down on that a lot. And that's why the Chicago Bears couldn't do it, because they don't want no smoke with the IRS. They don't want no smoke with Illinois State, because the Department of Labor also gets involved in these issues sometimes too. And matter of fact, I've actually went through some audits with the Department of Labor because I had clients who misclassified their employees / workers as independent contractors because they wanted to save some money instead of actual W-2 employees. And they got hit with a pretty hefty fine because they were out of compliance. So you got to be careful with that. But it's three things you got to think about: behavioral control, right? You see this right here. Financial control, relationships to the party. All right. Behavioral control is who controls when said worker works. All right. I'm going to read the definition. Does the company have the right to control what the worker does and how the worker does the job? Right. So are they telling you what to do, how to do it, what tools to work with, what tools not to work with? You know, they have control over that. So that's one form of control when we're looking at proper classification of workers. All right. Financial control. All right. That's number two. Financial control. I'm going to read this here. Does the business direct or control financial and business aspects of the worker's job? Are the business aspects of the worker's job controlled by the payer? Things like that, how the worker is paid, right? So the Bears will be paying Caleb Williams, right? And Caleb can't go anywhere else and make any other money. So the Bears have financial control. Let me back up to step number one, behavioral control. Guess who sets the schedule for when the games are played, when practice is played? Caleb can't really dictate that now. His separate workouts, he can dictate and do that. That's part of being an athlete or professional athlete. But the league already has a schedule of games, right? The team, because you got to remember, there's the NFL, the governing body. Each one of these teams are individual businesses. The individual businesses control the workout schedules, the practice schedules, and things like that. The NFL controls the actual game schedules. They control when the playoffs are. They control when the Super Bowl is, things like that. All right. Last one, relationship of the parties. All right. Are there written contracts or employee type benefits, i.e. pension plan, insurance, vacation, pay? Will the relationship continue, and is the work performed as a key aspect of the business. So Caleb is the quarterback. Again, star quarterback. He's a sensation. He's there to work for the benefit of the Chicago Bears. So everything he does is to benefit them. So you gotta think about that. Now, as I mentioned earlier, is that when you misclassify these, and I mentioned it before, but I'm going to mention it again. When you misclassify your workers, oftentimes you might be cheating. You might not constantly understand you're cheating or know you're cheating, but you could be cheating. And what do I mean by cheating? So one classification that oftentimes is overlooked or taken out is that when a lot of times when employers label their workers as independent contractors, they're no longer paying they're no longer paying employment. Dang, I'm messing it up, y'all. Unemployment tax. So unemployment tax, the employee pays some, the employer pays some. They all pay the money into a pot. So if you get laid off or you get fired, you get unemployment benefits. If you're an independent contractor, you don't get any of that. Now, what normally happens a lot of times that I see it, people don't realize that they're independent contractor, because part of the things that happens when you're an independent contractor is, one, you get a 1099. Two, you have to pay your taxes yourself. You pay your taxes on your own. You don't necessarily pay, your employer doesn't pay it. So, all the stuff that everybody complains about, the federal wage tax, the FICA, the state tax, the Medicare tax, the employee is responsible for that. The worker is responsible for that. And so when they're not paying that in the system, when the employee actually was supposed to be paying it into the system, they're kind of cheating the system. Well, that's not me making it up. That's the IRS and the Department of Labor. And so when they see you're not paying into unemployment, they're like, oh, but you actually have real employees, but you're not paying into the system. Guess what? You're also not paying into Social Security and Medicare. That's that whole FICA tax thing, that tax pay stub that a lot of people overlook or kind of forget about, right? So those are things you have to think about when you are in business. If you are starting an LLC or some kind of business entity, by the way, everybody doesn't have to have an LLC to do business. Also, most people that file LLCs are actually wasting money, but I'll talk about that in another show. All right. So again, you have to think about that. Now, Caleb's about to get a whole bunch of money. And I'm sure that's why he didn't want to pay them taxes or thought he can get a benefit from those taxes. But I want to pull up something. I made some slides real quick so everybody could see this and break this down, because a lot of people don't understand tax brackets. And Caleb is in the highest tax bracket. He's paying the most money. And I'm sure his feelings are going to be really hurt when he gets that first signing bonus check, that $25 million, because that thing's going to be taxed like crazy. That thing's going to be taxed like crazy. And so I just pulled this up real quick. All right. So Caleb's got some new tax problems. All right. So he got a $39.5 million contract, right? We talked about that already. All right. Now, this is how tax brackets break down. A lot of people kind of glaze over this and don't think over this, or they kind of think about it in the wrong way. But there's roughly 7 tax brackets. All right. There's 0 to 10%, then 10% to 12%, and then 22%, 24%, 32%, 37%. All right. But a lot of people don't realize that let's say Caleb's in the 37% tax bracket. However, all his money is not taxed at 37%. He has to go through each one of the tax brackets, right? So the first 11,000 is taxed, 11,600 is taxed at 10%. The next 11,601 to 47,000 is taxed at 12%. And then so forth and so on. 47,000 to 100,000 is taxed at 22%. And then the next 105, excuse me, 100, 500, 26,000 through to 200,000 is taxed at 24%, right? I can see why a lot of people get confused, right? It's not short and sweet to the point. There's 7 factors you have to think about when you're a Caleb Williams and how your taxes are going to play out. All right. And then again, the highest tax bracket is 37% when you make over $539,000, almost $540,000. So he's going to be upset. Now, you ain't got to be a math genius to go through this, right? His contract is $39.5 million. Well, that 0.5 is basically, that's all, everything over that is taxed at the highest bracket. So the majority of his paycheck for the bonus, well, excuse me, all of it actually, but especially the bonus is going to be taxed at 37%. So I get why he wants to be creative. And actually, everybody should be creative and everybody should be planning on how to reduce their tax liability or their tax bill. All right, now, this may be a little small, but this just kind of runs through what taxes Caleb is going to pay. All right. So in the first $11,600, he's going to pay $1,160. On that next rung up, he's going to pay $4,266. On the third rung, at 22%, he's going to be paying $11,743. All right. The next one up, 24%, he's going to be paying roughly $24,042. Now, when you look at it, it all kind of lines up. Now, when you get to the next tax bracket, which is the 32% tax bracket, he's paying $108,444. Then when you get to the 37% tax bracket, he's paying about $1 million, almost $1.1 million. It's a lot of money, y'all. It's a lot of money. So his annual tax bill will be $1.2 million, $1,245,000. All right. Now, remember I said the bonus, the $25 million bonus is coming out in the first year. Also keep in mind, this salary does not include like you get extra money if you make it to the playoffs. You get extra money if you get to, let's say, the Super Bowl. All right. And when you are an athlete, you have a premier brand. And a lot of times you can do brand deals and get more money too. So that's just the NFL money. That's not all the money he has coming. But let's go back. Let's go back to this real quick. All right. But I projected that over the life of his 4-year contract, he's going to be paying about $4 million, almost $5 million. So $4,980,000. You might as well round it up and say $5 million he's going to be paying. But wait, it gets worse. All right. And so here's just an illustration of what you got to go through all the brackets. Like I said, he's at the highest bracket, 37% bracket, but he's not paying 37% taxes on everything. All right. So just keep that in mind. And if y'all want these slides, I'll make them available to y'all. Just let me know in the comments that you want the slides. Just say, I want the slides. All right. And so, like I said, he's going to owe first year $1,245,000 total. And this is just federal taxes, y'all. Total federal taxes over the 4-year life of the contract, it's roughly $5 million, just rounded up. Now, state tax. And there's a little thing that they call the athlete tax. Some people call it the Jordan tax, right? That's when you go play games in other cities and states, you got to pay them too. So because you make money in those states. So that gets a little funky. But just in Illinois, just in Illinois off of his signing bonus, he's going to be paying $1,262,000, $250. All right, almost 1.3 million bucks. All right, now on his salary, he's going to be paying roughly $173,000. Still a lot of money. It's a lot of chips, y'all. A lot of chicken. All right. Over his 4-year contract, he's going to be paying 1.2, almost 1.3 million. And the signing bonus is 1.9, almost $2 million. So it's a lot of money, y'all. It's a lot of money. So I get why he would want to try to shift. I get why he wants to be proactive, as we all should be, when it comes to your taxes. You all should be proactive. Listen, you pay too much money in taxes just to be sitting on your laurels and being lazy and saying, I can think about it later. Everything is taxed, y'all. Everything. Like, it's really crazy. Everything from your income. You get taxed when you make money. You get taxed when you buy stuff a lot of times, depending on what state you're in. Our cell phones have tax, gets taxed. Your cell phone bill, look at it, right? Where you're at, maybe a sales tax. Again, there's taxes on top of taxes on top of taxes. So it behooves you to be proactive and start doing some tax planning and being very strategic in your tax strategy. And again, hopefully Caleb has not only just a good financial advisor, but also a good tax advisor as well to help him mitigate some of those taxes, because he's going to have a tax bill. He's going to have a tax bill. And hopefully, he doesn't do what so many athletes have done in the past and just blow all the money because they see this big lump sum of money coming at one time. And it's like, geez, I can get a Maybach. I can get a Ferrari. I can get a Porsche. I could buy this major home, right? Not necessarily. You might want to think about that, because there was a stat, and I have to go back and look at that, but they say the average NFL player who plays less than 3 years in the league typically files bankruptcy. Now, Caleb is already ahead of the game because his contract is guaranteed. So that's a great thing. So, that's a little change, right? It's a step forward. It's definitely a step forward. And so hopefully he's smart with his money and he can make this money not only for his lifetime, but hopefully future generations' lifetime as well. But again, he should be thinking about, all right, I'm going to get hit with these taxes. What can I do going forward to reduce my tax bill? Should I look at starting a business? Should I look at starting or getting involved in real estate? Should I look at investing in other investments that are very, very tax deduction heavy or favorable, I guess is the better term. There's a lot of things you can do, especially when you are a business owner or some type of investor, especially a real estate investor. They definitely have a lot of tax benefits when you're in that game. So again, if you're not thinking about these things, one thing that I kind of deal with every year during tax season, right? People don't think about taxes all year long, even though every time they get paid, if they're an employee, they're paying taxes, but they don't think about it. It's out of sight, out of mind. But they wait till tax season to start thinking about ways to maybe do their books if they got a side hustle, or they think about ways of, oh man, I brought some electric vehicles. Can I write that off? Not some. I brought an electric vehicle. Can I write that off? My children are in daycare. Should I write that off? But I don't have any receipts. So they're not even keeping receipts. Listen, the real cheat code, y'all's organization. The better organized you are, the better you'll be able to take advantage of tax planning and reduce your tax bill. So if you don't like paying Uncle Sam unnecessarily, I would strongly, strongly, strongly advise you to get organized. And it doesn't take a lot. Just figure out where you're going to put all your receipts. Figure out, if you're a business owner, how you're going to do your bookkeeping. Figure all that out. So, again, you have to think that out. And I see there's a comment in the questions. If he had an LLC, would he save money? No, not necessarily. And I went over this a few minutes ago, but I will go over it again, because I know with LLC Twitter, LLC Instagram, trust fund TikTok, all these tax experts are on there, and everybody loves to listen to the people that are not accountants for some reason or another. But I don't know how these things get going. But usually there's no tax benefits for having an LLC. And again, I said it earlier, but I'll say it again. A lot of times you don't even need an LLC. And most people who get LLCs are actually wasting their money. And sometimes creating bills for themselves. And I'll come back and I'll do an episode on that. So make sure that you subscribe to the Tax Problem Solver channel, the Tax Problem Fixer channel on YouTube, the Tax Problem Fixer channel on YouTube, and the actual audio podcast will be out soon as well, under the same name, the Tax Problem Fixer, the Tax Problem Fixer. So, keep that in mind, because again, people waste a lot of money. I mean, y'all let the government rob y'all, like willingly just rob y'all. Government ain't got a gun, and y'all just a lot of times just give them money because you're not being smart about it. You're not being proactive about it. Listen, anything in life worth having, you got to be proactive for it. Anything in life that's going to give you an immense benefit, you have to be proactive. What do I mean when I say proactive? Well, you have to be willing to take action first a lot of times, right? Let's think about relationships. A lot of people, I'm not going to get fresh here, but women oftentimes complain that the man didn't plan a date. Why didn't he plan a date? What's going through their mind? Oh, he doesn't think enough of me to put time and energy to think or research through where we could have a great, enjoyable time out together. They want that thoughtfulness. Well, guess what? The government's the same way. They're like, all right, well, if you're not going to think about it, we ain't going to think about it for you either. And so a lot of times people have that same mentality. Things take work. Anything that's awesome takes work. Guess what? If you got a child, it takes work. Well, if you want a good human being, right? And I tell people all the time, the role of a parent is not to raise a child. The role of a parent is to raise an adult. It's a whole other mindset. And, you have to think about that. Now, I want to keep these short and sweet. This is the first episode. I'm going on over 30 minutes. That was not the plan. My plan is to have these to be somewhere between 10 and 15 minute little short snippets. But I'm being reminded, people say I talk too much sometimes. So if y'all think this is too long, just let me know. Throw it in the chat, throw it in the comments. And again, I won't belabor this too long. But remember, tax planning, you should be doing it all year long. Don't just wait till tax season when February 2025 comes around, or January 2025 comes around, or April 15th of 2025 comes around. Start planning now. All right, we are a little over halfway through the year. Now's a great time to start thinking about it. Are you maximizing your deductions? Are you tracking your deductions? I don't even want to talk about bookkeeping. I might even start a whole bookkeeping division. There's so many people who don't have good books out here. It's so crazy. But when you don't have good books, typically you wind up overpaying in taxes. So you don't even give yourself a fighting chance. So keep that in mind, y'all. And I'll also do an episode on that as well, about things you can do to do better bookkeeping, things you need to do to have good practices. You got SOPs, right? Standard operating procedures. Well, you should have SOPs when it comes to your books. in your taxes. So you just follow the same thing over and over and over again. And I know it's not sexy. I know it's boring, but it's something that will save you money, save you frustration, and will actually save you a lot of heartache. Because, quick story, sometimes I will volunteer and help people with their taxes. Like I'll do work with, let's say, the ABA, the American Bar Association, and I'll work with one of their lawyers along with the IRS. And I run across some really interesting cases, a lot of interesting cases. One case, business owner owes $1 million. Can you imagine what it feels like to owe $1 million to the IRS? I ain't gonna say much more. I'll probably do a case study on that at some point. Give it some time so nobody's looking at me. But I got case studies for days. I could talk about that, so I'll be doing those as well. But if you have any questions, any tax questions that you want me to cover directly, feel free to shoot me a text, shoot me an email. You can email me at phillytaxteam@gmail.com. Again, phillytaxteam@gmail.com. And if it's a good question, we'll talk about it on the show, and I'll definitely highlight you and highlight your business as well. And so until next time, y'all, I'm Kamari Ellis. I'm out. Thank you for watching the very first episode of the Tax Problem Fixer Show. And I'll be back soon, y'all, to talk to y'all about these taxes. Have a great day.